Hello, DR.
Richard, great to see you again. I know you've got some adventuring coming up, so I'm glad we're getting the recording out a little bit early this week.
Yeah, how you doing back home after Epsilon Connect?
Wow, it's a little bit of a culture shock not being around all those people after that first business trip in quite some time, and
Right.
I'm having a little bit of Richard Smith withdrawal, but that's okay. That was to be expected.
Well, the markets haven't disappointed in terms of keeping things interesting this week, have they?
They have not. I mean, I hope we get to talk about a lot of things. We're in some weird places on cycles. We've had markets going in different directions by multiple percentages in the same day.
Yeah.
Small caps way up, S&P way down, NASDAQ way down in the same day. And it's like the craziest thing. And I know you're going to comment on that a little bit and we'll talk about it. But this is some unusual markets that we've seen since we've been back.
And yet the VIX is what, at 14 or something? I mean,
Yeah, two straight
hey,
closes below there.
everybody's chilling. I don't know. Doesn't add up to me, but let's look at some charts.
Let's do that. First chart up. This is basically a version of the yield curve, the 10 minus 2. So the 10-year Treasury minus the 2-year Treasury, constant maturity, dating back to way back into the 70s.
So we are today at the end of the chart there. Let's see, we dipped below 1, probably back during the Silicon Valley Bank, Signature Bank crisis.
I think that's correct.
Um,
I'll just draw something on here since I can. That's the
yep.
zero line.
So
That's
we
if they
really
were.
haven't seen, this negative of a yield curve back until, the early 1980s. It wasn't this bad during the Great Recession and the financial crisis in 2008.
Yeah.
So, and it doesn't, we're not at the lows, but things are kind of turning back down here. And basically, this means that short-term 2-year rates are higher than the 10-year rates, which continues to make life very difficult for lending and for lenders, right? So hard to see how the economy really gets going when lenders are under pressure because they can't borrow short and lend long, right? I was at the bank the other day with my son actually, and the default interest rate on a checking account was 0.1%. So if banks can get a lot of people to give them money and only pay them 0.1%, and then they can go out and get 2% on some longer term money, okay, that can work. But most people aren't accepting 0.1%. They're putting their money in CDs. You can get a 7-month CD for 4.5%. Money markets are probably around the same. So this continues to make life difficult for lenders to loan long-term money, and it's hard for me to see how that's good for the economy.
I saw a piece on that last week, Richard, or a piece of data that the banks had one of their biggest outflows in the month of May that they've had in many decades. People are starting to realize they're starting to go to the bank like you and your son did, and seeing the same thing. I
Yeah,
can't get any money,
crazy.
even in savings, let alone
And then
checking.
that in a year, the money that you've got in the bank that's earning 0.1% is going to be worth 5 to 8 to 10% less. So banks don't look good to me here, and lending doesn't look good to me here. That makes it hard for me to get excited about the budding stock market rally. So
And I
let's
think
move
that'll
on.
show up in a chart that we're going to look at here soon. We're going to look at a bank index chart. So I think you're
Okay.
right there, Richard. Let's pop to the
Next.
next one. So here is a good proxy for shorter for intermediate term inflation. Let's call it a break even rate, where we're trying to look at what kind of rates do you have to get in order to be able to break even over the long term. And the long story short, this one is showing, and here late in 2023, we're showing some decline in inflation. I think that is a positive with the other things that are going on too.
Right. So this is saying, over a 10-year period, you better earn, 2.25% in order to keep pace with inflation. So I wonder if this is what the Fed means when they say, our target is 2%. Do they mean it over a 10-year period, or do they mean year over year?
Yeah.
I'm guessing they mean year over year. But look, we're down on a 10-year break even rate. Overall, that's better than being at 3%. So I do think that gives a little bit of breathing room.
Well, let's jump in and look at equities for a couple of charts here. I want to look at some. I want to look at some comparison of some equities, and we'll start with the Nasdaq divided by the S&P 500. So, how those two indexes have been moving relative to each other.
So when this chart's going up, means the Nasdaq's outperforming the S&P, and when it's going down, it means the S&P is outperforming the Nasdaq.
Right, and you can see from
This is
the
only looks like about 18 months or
yeah,
so.
so right, so from early on in 2022, if we get back, that's 2021 where it kind of peaked out, and through the down market year of 2022. The S&P outperformed all the way into the bottom, down into late October here, and then kept going into the new year. It's only been the new year, Richard, that the tech heavy stocks and really the big seven heavy Nasdaq has been tremendously outperforming the S&P.
Yep, and we touched on that in past weeks. Those companies are cash rich. They're kind of fortresses. You feel like your money's safe. There's some risk on when you think the Fed might be ending their tightening cycle, which they aren't. And but we've seen a little change over the last week or two, which is that dip there at the end on the right, with the S&P starting to outperform the Nasdaq, or the Nasdaq underperforming the S&P.
Yeah, and interesting in that is that the S&P has stayed very near the top of the chart, while the Nasdaq has been its usual bouncy self, popping up and down. But I think that the fact that both Australia and Canada have chosen to raise rates again after pausing has given people some reason to think that we're not just going to go into a pause, drop rates again mentality.
I agree. And the NASDAQ has obviously enjoyed a heck of a ride since January of 23. No surprise to see it pulling back a bit.
Yeah,
A little
I think
surprising to see the S&P holding up as well as it is above 4,200 right now.
I think I agree. After the breakout that we talked about last week, Richard, I think that's very true. Here's a surprise over the past few days. The small caps, the Russell 2000 small cap stock index has been outperforming everything early and into the mid part of this current week. It's just been rocketing up.
You got to say, this is an encouraging sign. I mean, the small caps, the smallest stocks, are starting to outperform even the S&P 500. I'm sure if you had that over the NASDAQ, it would be even more dramatic, because I think the NASDAQ's been down while the Russell's been rocketing up. The market's been very narrow, with just these 7 big tech stocks leading the rally. And now we are seeing some liquidity move into the smaller stocks, which is exactly what this chart is showing. and a check mark in the bulls column here, I would say.
Yeah. And I think often we look at that, you have to balance. There's never all the factors on one side or the other. And one of the things I love the way that you can bring that balance. Some people can't even think about it or see it. And let's balance that good news from the small caps, Richard, with what we're seeing on the chart now, which is the banking index, the
Back
regional
to our
banks
yield
here.
curve chart.
Yeah, indeed.
So the
Indeed.
banks, not acting exactly like the Russell 2000 here. Over the past few weeks, they've gained back a little ground, but boy, that's a pretty pathetic rally in the banks considering how far they fell during the banking crisis. And I think, look, it's a tough time for banks. Whether or not there's going to be another bank failure or two or three or four, which I um, think is a pretty good chance that we could see more bank failures before all is said and done. It's just a bad environment for banks right now, period. And, that's what we're seeing.
And the regionals are struggling even more so than the megas, but it's probably a pretty fine point to even go there. So
Yeah.
let's if you're okay, why don't we switch gears and talk some cycles for a minute, because I think some interesting things are happening in the cycle world as well. We have two S&P 500 charts on different time frames to look at
Yeah.
here.
So again, what we're going to see is conflict. Sorry to say, but this is a chart of daily data of the S&P 500. Looks like it goes back about 5 years or so. There's a very clear 169-day cycle in the daily data on the S&P 500. And you see, topped in right when the market was topping in 2022, got a top in September of 2022 again, and a bottom in early 2023.
Right.
So, meanwhile, the cycle on the daily data right now is definitely pointing down. Now, the S&P hasn't cooperated yet, but the daily cycles are absolutely a headwind for the market right now, and showing a bottom in August to September or so. But this is in contrast to what we'll show in the next chart, which is looking at cycles on the weekly data. So this chart goes back to the early 2000s. This is the 182-week cycle, which is about just short of 3.5 years, which is really one of the most stable cycles anywhere, period. It's also known as the 40.7-month cycle. And this cycle called the market top in late 2021 and is bottoming right now. So if you look at the little at the bottom there, you see a little circle where the market is today, where we are in that cycle. So on a weekly chart, in weekly data, when we're looking at the cycles, we're in the bottom formation period. So check mark for the bulls. Daily check mark for the bears. Weekly check mark for the bulls. So if we look at everything, DR, we got headwinds for lending, for the banks, which is tough for the economy to get off the ground. We got the NASDAQ correcting, but rotation into the smaller stocks, including the S&P 500 and the Russell. We got bearish headwinds on the daily chart with cycles. We got bullish headwinds on the weekly chart with cycles. So it's just a tough market to make any sense out of. I continue to be concerned that we could see another shoe drop before the fall. We've gotten what you could call a breakout over the past week, right? The S&P has held above 4,200. I'm I'm not fired up about the markets yet. I don't know about you.
Yeah, it has broken out and stayed up there over a week. It'll be interesting. We have seen bull traps before that caught some people in that. However, like you said, there's cases to be made on both sides here, and I think it is a market where doing some diversification and being able to not have to watch tick by tick probably behooves most of the people that like to listen in on your insights. Um, but I have another insight I bet they would like to hear about as well, Richard. I'm going to pop off our screen and we can just chat for a minute here because I think we'd love to talk about what's going on in the world of crypto. People have been following you and what you've been talking about with that for a long time. And both Binance and Coinbase have had some not so good news, some interesting news come out this week.
Yeah. Finally, the SEC has taken its stand, right, and filed lawsuits against both Binance and Coinbase, more importantly. So we haven't seen Coinbase collapse. I think on the whole, this is good for Coinbase, as contradictory as that sounds. But I think we might have a sort of analogous story here as we had with Live Golf and the PGA.
Uh-huh.
All right.
Mm.
So I think this is the SEC shot against, over the bow of the crypto industry, which, I think they waited until the right moment, frankly, when sentiment in crypto wasn't as robust as it was a couple years ago. I think there would have been a lot more people up in arms if the SEC had made their move a couple years ago. I don't think it's great that the SEC has been so long in clarifying the rules around crypto, right, and only bringing enforcement actions. But I do think that on the whole, the SEC and Coinbase are going to find some way of sorting this out.
Mm.
And that, I think Binance is in more trouble than Coinbase. I had a Binance account, which got shut down over the past couple of weeks.
Wow.
It wasn't the Binance US account. It was an older Binance account before they
Mm-hmm.
had Binance US. And, on the whole, that's got to be good for Coinbase. So, meanwhile, whether or not Coinbase, whether or not the exchange model around crypto is
Mm.
really the right model for crypto, to me, that's the more existential question for crypto, right? Is crypto ever going to be something more than just a way to trade more assets, right? And Coinbase is essentially an exchange. They're not
Correct.
really acting like, you know, an exchange that is facilitating capital formation to to ultimately, produce innovation. And what are people really using crypto for at this point, other than trading profits or
Other
trading
than
more?
trading, the great promise of the exceptionally low cost medium of exchange that would help people regardless of your economic class. I would love to see that promise come to pass, but it's not where they're concentrating right now for sure.
Yep. And we're 12 years in since Bitcoin, right? I mean, think back to 12 years after the
Wow.
dot com, even if you take it in 1998, 12 years was in 2010.
Yeah.
We had a lot of significant development in the industry of real consumers using, real internet based businesses, right? And we just haven't seen that in crypto yet. So I think that this is a political move on behalf of
Mm.
the SEC. I think that in the end, it's bad for Binance and good for Coinbase. And I think that looking beyond this, the big question is, can crypto ever really get a foothold in terms of real products used by real consumers at scale? And I haven't seen it yet.
That is a fantastic summary, Richard. And with that, I think it is probably time for you to turn your thoughts toward the wilderness and doing some things that are lots of fun with your family, your sons in particular. And I can't wait to hear all about it when you get back.
Looking forward to getting off the grid. Good to see you, DR. Have a good weekend.
All right, you too. God bless you now.